Ever wondered how expert day traders predict market moves with uncanny accuracy? Well, it's not magic, nor is it purely luck. It's all about recognizing patterns. Yes, patterns. Just like a detective looking for clues at a crime scene, successful day traders search for specific patterns in the market's price action. These patterns are as important to traders as a compass is to a sailor. Why? Simply put, they provide clues about future price movements. Understanding these patterns can make the difference between making a profitable trade and losing money. They are the building blocks of technical analysis, a method used to evaluate securities and identify trading opportunities. Recognizing patterns is like learning a new language. Once mastered, it can open up a whole new world of possibilities. So buckle up your seatbelts and put on your thinking caps. Get ready to delve into the world of day trading patterns, a powerful tool that can help you make informed trading decisions. Imagine a flag fluttering in a strong wind. Now, imagine that in the stock market. That, my friends, is the essence of the bullish flag pattern. It's a common scenario in chart analysis, a pause in a trend that's heading upwards, much like a flag at half-mast. The pattern forms when there's a sharp price increase, creating the flagpole. This is followed by a consolidation period, creating the flag. This consolidation period is typically characterized by lower trading volumes and a slight downward trend in price, which can be quite misleading. But don't be fooled. What the bullish flag signals is a potential continuation of the upward trend. The market is merely catching its breath, preparing for the next upward surge. It's like a coiled spring just waiting to release its energy. So, when you come across this pattern, keep an eye out for the breakout. That's your cue. So remember, when you see the bullish flag, it might be a good time to make your move. Now, what if the wind was blowing in the opposite direction? That's your bearish flag. This chart pattern is a mirror image of its bullish counterpart. It's like a flag flying at half-mast on a gloomy day, signaling a potential downward price movement. Imagine a steep, fast drop in prices. This forms the flagpole. Then, the market takes a breather, prices move in a narrow range, forming a rectangular flag. But they're still leaning against the wind, against the previous downtrend. This consolidation phase is short-lived. The bearish momentum regains control and prices resume their downward march, completing the flag. Traders, remember this. The bearish flag is a continuation pattern. It tells you that the bears are just catching their breath before they continue their run. So when you spot a bearish flag in your chart, it's a heads up. The bears might still have the field. The bearish flag tells you it might be time to hold off on buying. Ever seen a W in the stock market? That's your double bottom. This pattern is a classic signal of a possible reversal in a downward trend. It's like a giant W painted on your price chart. Here's the gist. The double bottom forms after a prolonged downtrend. The price drops to a certain level, rises again, only to fall back to the previous low. This forms the first 2 points of the W. The key here is that the second bottom shouldn't be significantly lower than the first. If it is, you might be dealing with a continued downtrend instead. Now, when the price rises again and breaks the peak formed between the two bottoms, we've got the third point of the W. This is the confirmation that the trend might be reversing. What does this mean for you? Well, if you've been holding onto a stock through a downtrend, the double bottom could be your sign that things are about to turn around. When you see the double bottom, get ready for a possible upward swing. Now imagine a wave, not just any wave, but an Elliot wave. The Elliot wave, named after its founder Ralph Nelson Elliot, is a unique pattern that you might find surfing the waves of the stock market. It's an intriguing pattern that, like the rhythm of the tide, ebbs and flows in distinct phases. The Elliot wave pattern is broken down into a 5-wave formation. Picture this. The first wave, often called the initial wave, is where the prices start to rise. This is usually caused by a small number of people who, for whatever reason, feel the market will rise. The second wave, the corrective wave, is characterized by a price movement that goes against the trend of the first wave, but doesn't exceed its starting point. This is where some people take their profits, causing prices to dip. Then comes the third wave, the impulsive wave, where prices surge upward. This is often the longest and most powerful wave, driven by large numbers of traders jumping on the bandwagon. The fourth wave, another corrective wave, is a slight pullback as traders take their profits. But this wave doesn't go as low as the second wave. Finally, the fifth wave, the final wave, is where prices push higher one last time. This is usually driven by the last remaining optimists before the pattern starts over again. This rhythmic five-wave sequence can help traders predict market behavior. By identifying these patterns, traders can anticipate potential price movements and make informed decisions. The Elliot wave is more than just a pattern. It's a narrative of the market, telling a story of optimism, profit-taking, herd mentality, and final surges. It reflects the collective psychology of the market, and that's why it's such a powerful tool for traders. Remember, the market is like the sea, full of waves and tides, of ebbs and flows. And to navigate these waters, you need to understand their rhythm, their pattern. The Elliot wave is your surfing guide to the stock market's waves. Ever seen a Head and Shoulders in the stock market? No, not the shampoo. Let's dive straight into the Head and Shoulders pattern. Imagine a formation that resembles a head with two shoulders on either side. That's your visual clue. But what does it imply? Well, it's a telltale sign of a potential trend reversal from bullish to bearish. So, how does it form? The pattern begins with the creation of a peak, followed by a larger peak and then another smaller peak, forming what appears like a human head and shoulders. Each peak represents a price level. The first and third represent the shoulders, while the highest peak, the head, sits in the middle. The crucial part is the neckline. This is a support level drawn by connecting the lowest points of the two troughs. A break below this line signifies a trend reversal, indicating it might be time to sell. The Head and Shoulders pattern is your warning sign of a possible market downturn. Now imagine a triangular flag on a post. That's your pennant. The pennant, a powerful day trading pattern, is a small symmetrical triangle that signals a continuation of the current trend. Picture a market rally, an intense surge in price, like a flagpole. Following this rally, the market takes a brief pause, moving in a narrow range, forming the pennant. This pattern is characterized by converging trend lines, much like the sides of a triangle formed by highs and lows within the consolidation period. The breakout, a sharp movement in the direction of the preceding trend, usually happens after the price touches the trend line 3 or 4 times. Interestingly, the pennant doesn't discriminate. It can wave in both bullish and bearish markets, signaling a continuation of both upward and downward trends. The key is to look for a strong movement, the flagpole, followed by a consolidation, the pennant. The pennant is your signal that the current trend is likely to continue. Ever seen a slice of pie in the stock market? That's your rising wedge. Imagine a slice of pie. It starts wide at the bottom and narrows towards the top. The rising wedge pattern in day trading mirrors this shape, with the price action contained within 2 upward sloping lines. The lower line represents the ascending trend line of the stock's lows, while the upper line represents the stock's highs. As these lines converge, it forms a shape that resembles a wedge, hence the name. This pattern tends to form over a 3 to 6 month period, although it can appear over a shorter or longer time frame. It's important to remember that the rising wedge can form in both uptrends and downtrends. However, the implications of the pattern differ depending on the context. In an uptrend, the rising wedge can signal a potential bearish reversal. This means that the stock's upward trend may be losing steam, and a downward turn might be on the horizon. This happens when the price breaks below the lower trend line of the wedge, signaling that sellers are gaining control. It's a warning sign to traders to possibly exit long positions and consider short positions. In a downtrend, the rising wedge can serve as a continuation pattern. This means that the stock's downward trend is likely to continue after a brief pause. Again, the key signal is the price breaking below the lower trend line of the wedge. One key to interpreting the rising wedge is volume. As the pattern forms, volume typically diminishes. Then when the price breaks through the lower trend line, volume often increases, confirming the pattern. Remember, like all trading patterns, the rising wedge isn't foolproof. It's just one tool in a trader's toolbox, and it should be used in conjunction with other indicators and analysis methods. When you see the rising wedge, brace yourself for a potential downward turn. So patterns in the stock market, huh? More common than you thought, right? We've journeyed through the labyrinth of day trading patterns, from bullish and bearish flags waving signals to traders to the double bottom pattern, often a sign of potential upward price reversal. We've surfed the Elliot wave, understanding its intricate five-wave sequence, and got acquainted with the head and shoulders pattern, a reliable indicator of a potential bearish reversal. The Pennant pattern, another flag-like formation, made a grand entrance, and we wrapped up with the rising wedge, a pattern that warns of a potential price drop. Each pattern is a piece of the puzzle, a clue to deciphering the market's next move. So remember, while every pattern may not lead to a pot of gold, they can certainly steer you clear of potential pitfalls. With these patterns in your trading arsenal, you're one step closer to becoming a more savvy day trader.